Boeing, a titan of the aerospace industry and a cornerstone of the U.S. defense sector, is facing an alarming possibility: a downgrade to junk status. This potential downgrade could have significant repercussions for the company's borrowing costs and overall financial stability. On Tuesday, Boeing is set to release its airplane delivery figures for May, which are expected to be underwhelming. These figures are crucial as investors and analysts look for signs that the company can increase deliveries and generate free cash flow in the second half of the year to avoid a downgrade. Credit rating at risk. Boeing's current credit rating is perilously close to junk status. In April, Moody's downgraded Boeing's credit quality to Ba3, the lowest tier of investment-grade ratings, aligning with BBB- from other top rating agencies. Additionally, Moody's, S&P, and Fitch have all lowered their outlooks on Boeing to negative, signaling a heightened risk of future downgrades. A fall to junk status would escalate Boeing's borrowing costs and complicate its capital structure, which includes nearly $58 billion in debt. High-yield buyers may struggle to absorb this influx, leading to significant price volatility. Financial struggles. Boeing's financial woes are reflected in its bond yields. Bonds maturing in 2050 currently yield around 6.5%, while those maturing in 2030 and 2025 yield just under and just over 6% respectively. These yields are higher than the average for BBB-rated bonds, 5.7%, but lower than the 6.7% average for BB-rated bonds, the highest rung of junk status. Boeing has also struggled with free cash flow, using nearly $4 billion in the first quarter of this year and now projecting a cash outflow for the year. The Federal Aviation Administration, FAA, has capped Boeing's production of the 737 MAX at 38 per month, making it essential for Boeing to deliver near this cap to maintain its credit rating. Historical context and future prospects. Boeing's current predicament stands in stark contrast to its situation 6 years ago when it held an A rating. The first crash of a 737 MAX in October 2018 and a subsequent crash in March 2019 led to the grounding of the jet worldwide, triggering a series of rating downgrades. The onset of the COVID-19 pandemic further exacerbated Boeing's challenges, devastating air travel demand and disrupting the supply chain. In response, Boeing raised $25 billion in April 2020 and an additional $10 billion recently to bolster its liquidity, anticipating $12 billion in maturities over the next 2 years. Despite these measures, Boeing's leverage remains high, with its debt-to-EBITDA ratio expected to fall from the mid-teens in 2024 to 4 times EBITDA by 2026, according to Fitch Ratings analyst Nicholas Ferrone. Market perceptions. Investors remain cautiously optimistic, recognizing Boeing's critical role in the commercial aviation market, where it operates in a duopoly with Airbus. Adam Abbas, head of fixed income at Harris Associates, expressed confidence that Boeing would avoid a downgrade, citing the company's fundamental market position and the likelihood that its current issues would be resolved in the next 3 to 5 years. Ultimately, while Boeing faces significant challenges, its position in the market and strategic measures to manage its balance sheet offer some hope that it can maintain its investment-grade rating and navigate through its current financial turbulence.